Hello, my name is Guy. I'm the author of the book Business Valuation, but with subtitle Using Financial Analysis to Measure a Company's Value. Financial analysis, that means that we also have to know how we have to look to a balance sheet. And that's why we're going to talk about how do we have to read a balance sheet. All right, step one when you have to read a balance sheet is knowing the basic. This is very important. On the liability side of your balance sheet, you have the sources of financing. On the asset side, you have what the company possesses. Now let's have a look first to the sources of financing. We have equity, the money the shareholders put into the company, and we have long-term interest-bearing debts. That's normally towards the banks. These two together are called the long-term financing. Yes, it's the financing tomorrow you don't have to pay back to anybody. Further on the source of financing, we have short-term financing. It's short-term financing, loans you got from the bank, suppliers, etc. These are in fact the sources of financing. Or you paid it yourself, equity, or you have a loan towards the bank, or you haven't paid your invoices yet, suppliers are outstanding. That's a shortcut to tell you what are the sources of financing. What do we have on the other side? Very easy. We have the fixed assets, things you're not going to sell tomorrow, and you have the current assets, which is inventory, customers, and liquidities. Also, to say it in a shortcut. Now, what is important? Step one when you make the analysis of a balance sheet is calculate the long-term financing, and everybody should know that if you have long-term financing, there is one thing you should surely finance with it, and that are the fixed assets. It's very important, if you're not used to it, to draw out the blocks. Just make a drawing of the blocks you see. And this is the long-term financing, this is the fixed assets, and then you see these fixed assets, they are smaller than the long-term financing. So you have a kind of a reserve. And this reserve is called the net long-term financing. Long-term financing minus net fixed assets is net long-term financing. This is a kind of a reserve, but you have to know whether this reserve is big enough for the company. So a balance sheet is in fact nothing more than looking to the physical condition of the company. Here we go again. We have a nice drawing. It is a balance sheet. I draw out for you. And what is important now? Important is you have to make a management balance sheet of this balance sheet. So what do we do to make a management balance sheet? If you look to the short-term debt, the short-term debt exists of financial, interest-bearing debt, short-term interest-bearing debt, suppliers and other debts, non-interest-bearing debts. These non-interest-bearing debts, what do? You bring them to the asset side of the balance sheet. Then you have here inventory, customers minus suppliers, and that is the definition of the working capital requirement. This is what we call a compressed balance sheet or a management balance sheet. Very important, you always work with the management balance sheet. You have done that, you put in the suppliers into your asset side of your balance sheet. You have these blocks, the net fixed assets, the working capital requirement, the cash. There is not more than assets than this. And you have as sources of financing the equity, the long-term interest-bearing debt, and the short-term interest-bearing debt. Now you see the blocks. And what do you see? You see that the net fixed assets are financed by equity and long-term financing, because it goes like this is smaller than this one, and that a small part of the working capital requirement is financed by long-term, and the rest is financed by short-term interest-bearing debt. You see that the cash is totally financed with short-term interest-bearing debt. And how you have to look to this management balance sheet, you will find back in my session 2 concerning how to read a balance sheet.